And Connie, thank you so much for taking time to join our cohort here.
Thank you.
Thank you, Santosh, and thank you to everybody else for joining as well.
All right, so let me set the context, what we're looking for today, right? Personal finance has sort of taken center stage post-pandemic. It's a very interesting time to be in India. While a lot of our assets in terms of managing one's finance was largely locked in gold and real estate earlier, we are getting into the era of financialization as as we move ahead and build more and more access that is relevant to anybody and everybody in the country in terms of our discount brokers to access to various of the advisory elements also in the country. It has gone through a complete overhaul in the last 4 years. That also means there is going to be plenty of advice out there. And it's also important to start building our own internal knowledge before we choose a product, before we take a decision to deploy our money. While real estate and gold has a civilizational effect, or advisory pool that's out there from our grandparents to great grandparents who told that gold is the best form of asset creation, to real estate where there's a certain societal implication that gets built into buying a house. But finance, and more so when we talk about a personal finance, it is very, very internalized for each of us as an individual, and it changes the trajectory of my personal growth story, but also it changes from time to time when I start my career to where I'm today to 10 years hence, and the retirement journey that one will want to have. So given this whole context, today what we're looking at is between Connie and Amit, they're going to walk us through on some of the most important elements of learning the nuances of personal finance. Why do we even have to have that knowledge? What are those important frameworks that we can work on? And then we'll also take questions from the audience. There's a set of questions that we already have received earlier through our registration form as well. We'll also take those questions. And we hope that this session can build in an impetus for all of us to really start looking into our own personal financial journey in the most relevant way for our own selves. I'd like to invite Amit to walk us through the deck, and then we'll switch over to a conversation mode.
Perfect.
Over to you, Amit.
Thank you, Santosh. Much appreciated. So we'll kind of go through this presentation in two ways. I'll walk through the first half and then I'll let Connie cover the rest. But just to put in context, I think the idea behind what we tried to set up to do in the session was try to work through some basic principles so that all of us can create our own internal framework as to how we should invest. And most importantly, what tends to happen is, there are so many products which come to us. And so the more important part is, how do I determine what is right for me? What is it that I should be doing? So two aspects. One is how to determine what I should be doing. There are so many products. Does this make sense? Does this not make sense? I don't want to be taken for a ride. That's one aspect of it. The second aspect of it is just from a conceptual basis, what is it that we as investors, even people who are professional fund managers, how do they think of the world? How do they think of India in the context of the world? And therefore, how we plan a more, a global, how we plan for the world rather than just from an Indian context, right? So that's the idea. So let me just dive into it.
May I? So just before I'm so sorry, I missed out asking you both to introduce yourself. I think that yes, that was a
Okay.
context setting. It helps for my audience to know why should they listen to three of us.
Okay, perfect. No, that makes a lot of sense. So everybody, my name is Amit Khosla. I used to run a private equity fund. I started my career in New York, then in Hong Kong. Came to India in 2003 when I joined what was then and even today called Actis Capital, CDC, Commonwealth Development Corporation, which is one of the big buyout funds in India. I worked with them doing non-performing assets. I then was fortunate enough to set up my own private equity fund where I invested in financial institutions. I had marquee investors, all institutional investors, the likes of Hana Bank, Banco Santander, Aviva. So it was all institutional capital that we invested in India over an 8-year period. We were fortunate enough, the fund did really well. We did a 3x on our fund. And then 2015-16 is when I turned the chapter of my life where I said, what I have done on professional fund management, what I have delivered to professional investors, there's no reason why I cannot take these concepts and move them towards individual investors and make them think about investing from an institutional perspective. That's why ValTrust was created, to manage my own capital and similar-minded investors who want to do things in a slightly different, more institutional manner, rather than just looking at things which are available off the shelf. Connie joined me a couple of years ago. She's based in Dubai. Connie, you want to make a quick introduction? Please do that.
Yeah. So my name's Connie. My first name is Kanchka. I'm from Delhi, from India. I've been in Dubai for about almost 20 years. So my journey with personal finance began because at some point in my life, I had children and I had to focus on them. I have them and I've had to focus on them. And therefore, I think one of the things that worried me or bothered me, my own insecurity of not having a steady income, as to how I can make my own wealth grow, because as Indians, we're conceptually very, very good at saving, right? But the concept of how to make our wealth grow was still something that I hadn't quite toyed with. So, and I realized that there's a lot of women out there like myself that could, do with some help, which is more sound and earnest, by simply telling them what the principles behind investing are. And they can apply that to themselves and take it forward. My background is in sales and distribution with multinationals like Microsoft and Lenovo in the UAE, and I've been doing distribution and sales for about 20 years. But I'm truly passionate that I think everybody deserves the correct help to enhance their lives for the better. And that's why we launched the Empower initiative for women to help them get a better understanding of personal finance.
Thank you, Connie and Amit. Over to you, Amit.
Okay. Connie, can we just flip down? Okay. So I want to, I know this is personal finance, but I want to touch upon something which indirectly actually impacts us, which is the concept of currency depreciation. When I moved back to India in 2003, the rupee was at 40 rupees to a dollar. Today it's at 88. So I think one of the things that impacts us when we think about our wealth and our financial planning is the value of the currency in which we earn. Over the last 25 years, things have changed. A lot of our consumption bucket is priced in dollars, whether it's the oil that we consume, whether it's the cars that we buy, even whether it's the phone that we consume. I think I would tend to argue that the only part of our consumption which is not dollar priced to a great extent is the food we eat. And pretty much the way some of the consumption patterns are going, I think a lot of the food we're now beginning to have is also imported. And therefore, that is also theoretically impacted by the movement of the dollar, because the reality is all global commodities are priced in the dollar. So when I look at this, the thing that comes to me is, I know I'm earning in rupees, but I need to be cognizant of what is happening to the rupee versus the dollar, because my expenditure while in rupees is indirectly priced in dollars. So I just wanted to bring this to everybody's notice, that it's good to start thinking along those lines as to what impacts the price of the goods and things that we buy, because only then can we do financial planning. Yeah. So, I get asked by a lot of people, rupee's been depreciating so much. Is the rupee going to depreciate more? Is the rupee going to appreciate? What is happening? So as fund managers, we used to have a if you look at the rupee from 2000 to now, the rupee has depreciated on average about 4% per annum. Now, it's not a linear depreciation. It kind of goes up and suddenly there's a big drop and then it stays steady and secondly, suddenly there's a big drop. So, what is going to happen to the rupee? So here's one way of thinking about it. As fund managers, we use this concept called interest rate differential. So just think about it, right? If the US has interest rates of 2%, or any currency has interest rates of 2%, if I look at the euro just now, I can borrow the euro at 2%. The RBI over here gives me 5.5%. So if I was the world's smartest investor, I will borrow $1 million in euro. I will take 1 million euros at 2%. I will take that money, I will invest it in India. At the end of the year, I will earn 5.5% on my euros. And at the end of the year, I will take my money and take it back to Europe and I will just earn a spread. Now, this is a risk-free spread. Now, theoretically, if the world was really smart, everybody would be doing that. We would be flush with foreign capital coming in. Reality is it doesn't happen. The reason it doesn't happen is because the arbitrage that I make between the interest rate of the lower currency and myself, the higher interest rate currency, the higher interest rate currency over a period of time will depreciate by the interest rate differential. Because if this depreciation doesn't happen, then all the bond traders in the world will just keep on doing this again and again and again and make money for no risk. So if you look at the interest rate differential, which was there between the rupee and the dollar, let's say quite, pre-COVID, right? Or just after COVID, right? After COVID, the US said we will maintain low interest rates and they kept rates very low. We had higher rates. And if you see, the depreciation of the rupee has happened a lot. Now, people say, Amit, what do I think about the dollar and the rupee now? Well, I say, think about it. RBI is at 5.5%. The dollar is now at 4.5% because the Fed has just cut rates. 4.2% is the yield curve. So actually now I can say that the rupee will not depreciate that much against the dollar. So one of the things that we can use now, theoretically, when the Fed cuts rates, you would think that the dollar would get weaker, but actually the rupee is going to get weaker. So look at it this way, right? The rupee has weakened against the dollar, but if you look at the British pound, it has appreciated against the dollar. If you look at the euro, it has appreciated against the dollar in the last 6 months. So the dollar has become weak against every currency except for the rupee. And the reason is, if you look at the ECB rates, it's 2%. Dollar's at 5%. So the reverse is happening over there, right? The dollar is having the same impact. If you look at the euro, so what I'm trying to say is, when you're looking at personal investing, look at interest rates across currencies, and that may help you project what is going to happen to whether I'm investing in dollars or should I invest in euros, because now I can do LRS, right? Should I invest? I will invest in rupees, but should I be investing my LRS in dollars or euros or any other currency? So please force yourself to start thinking along these lines, because this impacts the value of any currency in which you invest.
If I may just step in, Amit, to sort of summarize and simplify it, well, a lot of these are jargons, which for a banker like me and you, it is in our normal
Apologies.
lingo.
Sorry, please.
But for a lot of my audience who are coming from the academic world, and also there are students who have joined us. So just to sort of sum it up and make it easier to understand is that dollar or the global currency movements have an impact on our individual life as well. Whether we like it or not, today we live in a globalized economy. What Amit was showing earlier was about the dollar's impact on the rupee in itself, right? Agar, if my fuel cost goes up, right? Even if I'm consuming something that is locally, but because I'm importing a lot of oil, which is paid in terms of dollar, my transportation cost goes up, right? Which in a way eats into my ability to buy more things. अगर मेरे पास 1000 रुपए है, वो 1000 रुपए का value will get depreciated because something else happened outside of my control, which is the US market or the Indian rupee versus US dollar, which is absolutely out of my control as an individual. But because we are in the globalized world, I need to be keeping an eye out to understand that there is a regular depreciation that happens at the currency level also. And the next slide, he's double dipping and showing us the impact of the interest rate also. Essentially, my interest rates in India will go up and down. That we all know, because if we have our home loans, personal loans, the interest rates keep changing. But what's more interesting is also that these numbers have an impact of what's happening in the external world as well, right? India is not an isolated country, which means that me as a individual borrower will have a certain implication which is happening outside of the world. And if the dollar rate, I think about a day before, the Fed chief reduced by 25 basis points the US interest rates, that has an impact on me whether I like it or not. I may not be a citizen of US, I may not have anything to do with the US market, but just because we are globalized, any changes that happen in the market globally has a perennial impact on me as a user. So it's very important when we talk about personal finance also to keep an eye out on, we don't have to be experts at reading Business Standard or Economic Times, but at least I need to have an understanding of what are these primary movers or the fundamental movers of the market. One is the currency movements, and the other is the interest rate movements that happen across the countries, because we are in a globalized world. Hence, that's a relevant point for us to keep an eye out on.
Okay. The other thing, Connie, if we can, is, and I know this is something that we all are aware of, so I don't need to spend too much time on it, but inflation, right? Inflation is something which, let's go to this. Yeah. So inflation is something which also reduces the value of our purchasing power. And so when I'm thinking of investing, there is a basic thumb rule. I need to beat inflation, because if I'm not even beating inflation, then then there's no point saving. I might as well just consume today. If every time I save money, it's a choice between should I save it or should I do consumption. If I'm saving it and I'm being able to beat inflation, then the value of my money at least is staying the same. Otherwise, I might as well not delay any gratification, might as well just consume now. I'll explain this better in the next slide, which is this, right? So, and we at 6% inflation, here's what happens. If I have 100 rupees today, the purchasing power, what I can buy from that 100 rupees today, right? That 100 rupees is worth only 50 rupees 10 years from now, right? Because everything becomes more expensive. So the value of my ability, the goods I can buy for the 100 rupees. So if I don't make this 100 rupees 200 rupees, the point is the purchasing power of it reduces. And so I need my 100 rupees to grow. So when I'm thinking of planning for the future, it's about making sure my money grows at a rate faster than inflation. I think about it. Actually, if it's inflation and I add currency depreciation, I actually need my money to grow at inflation plus currency depreciation. So when you think about investments, the benchmark is not getting 6% inflation, beating inflation. Your inflation is, oh my God, one, my value of money is going down. Two, what I'm buying is going in dollars, and dollars is also becoming stronger. So I better make sure I earn 9-10% on my money as a basic. Otherwise, my purchasing power goes down. I think that's what that's why I brought in the concept of currency depreciation, that we need to think a little bit more than just inflation. Let's try to do inflation plus depreciation to make sure our purchasing power remains the same. Yeah. So, before I hand off to Connie, let's just go over this again, right? We need to make sure that we make our savings go up more than inflation. We make sure our savings grow up more than rupee depreciation. Combined, If I can't achieve that, the value of my money is going down. And then really I have a question, should I be consuming today? Why should I delay my consumption to the future? I might as well just consume today, because if I'm not doing anything with my savings, the value of my purchasing power is just going to go down and down and down over time. So please do think of these concepts. Connie?
So moving on and taking a cue from what Amit has explained in terms of currency depreciation as well as inflation, and how when I introduced myself, I said that we're very good at saving our money, but we don't really necessarily translate that into growth, to growing our money. So when we have, when we talk about different products in the financial sphere, I think a fixed deposit is something which is very common in India. It's something that we all know about. And if we look at some of the returns that we get on the fixed deposit, and we say that we get a 7% return, but your inflation is 6%, plus you need to pay tax, based on your tax slab, you're breaking even. So you're not really, your principal amount is not actually growing. And to this, we've not even added the devaluing of the currency. So it's really important to think wisely of the product that you invest in. I mean, I'm not at liberty to say what you should invest in, but certainly as an individual, it's important to know what different products there are in order to make the correct choices for your investment, so that your principal amount or the capital invested is growing at the rate that it needs to meet our personal requirements. So when we, investment options, and we look at the products that are offered to us, any return that we make on our investments is based on three simple concepts. It's really important for us to understand these three concepts, because the subsequent slides, including this, primarily speak about this. The number one thing is that your return is pretty much a function of the risk that we take. So the first important thing is, the lower the risk that we take, the lower the return, and vice versa. The higher the risk that we take, the higher the return. Okay. The next part, which would be diversification, there's different products available. You'll have equity products, you'll have debt products, you'll have a fixed deposit that comes under a debt, you'll have real estate. Now, how do I know which product I should invest in? So I have to look at what my risk appetite is. If I was a person that has a long-term horizon, I can invest in an AIF, which might have a lock-in, which it could be a PMS strategy that has a high return, but a high risk strategy in place. But it all depends on the place that I am in my life, and the place that I'm in my life. And the third part, which would be the liquidity. So if I'm able to lock in to commit to a product for a certain amount of time, right, I'm also reducing my liquidity. So if, for example, if I had to invest in a mutual fund today, where there is a diversified risk in the products that I invest in, say tomorrow morning, or next week from now, a week from now, I decide that I need some capital, it's required for XYZ purpose, I'm at liberty to pull out that capital in T+3 days. Whereas if I'd invested in a AIF with a lock-in, right, I'm making myself illiquid, or a real estate asset for that matter, right? While the real estate asset long-term could be giving me fantastic returns, but when I actually need the capital for a specific purpose, I may not be able to sell the asset as quickly as possible. So depending on what my requirements may be, I have to look at my investment options based on these three principles. So how does one actually think about building a secure financial future? I mean, for me, I related to your own, I think the human life cycle and the wealth life cycle are pretty much the same. We spend several years of our life working, trying to create a pool of capital for ourselves. We save, we make investments, we earn money. The most important thing to do is to make our capital work for us, for which we need to know which products we should be investing in. Again, like we spoke about the principles of investment, whether into debt products, equities, alternates, real estate, whatever works for us. Once we've been able to narrow down based on our requirements, the products that we want to invest in, I think it's really important to know that there are no guaranteed returns on any investments that we make. But one of the underlying factors that I think it's stuck in my head is that when the person who is managing your funds for you, if you learn how to do this yourself, fantastic. But if you have somebody at a bank or an advisory doing this for you, the people or the concept of risk mitigation, right, and capital protection are two fundamental facts that really help in making some good choices and safeguarding our returns on our investment, right? So once we've, sort of created this cycle for ourselves where we are constantly tweaking, we know what the market is, where the market is at. Like, for example, one must know that, in a good economy, when things are going well, you must invest. Like, a fund manager should be able to tell you, or your relationship manager tell you that, invest in large caps, invest in small caps, invest in mid caps. But if we have a problem, right, if you have a current situation, a problem in the economy, then you know what, stick with large caps, because small cap and mid cap funds might be a little bit more volatile currently. So these are the type of, I think, tricks of the trade that one must know as the fundamentals behind investments, in order to be able to leave behind a pool of capital, which is, it depends on your generosity, whether you want to use it for yourself or pass it on to the next generation. That's up to oneself. But, and then it's important to have all your paperwork in place, whether through wills, trusts, nominees at banks. These are all important things to think about, because it's not just, we see a lot of cases where one is able to create wealth, enhance it, preserve it. But we have situations where, once somebody passes over, how to actually distribute that to the next generation becomes a challenge. So it's not just about investments, it's about the entire loop being covered in a very systematic fashion. Coming back to the investment approach, because like I said, that the subsequent slides are based pretty much on the 3 principles of investing, is that one has to make sure that you try to avoid lock-in products and lock-in periods, because either the risk that is involved with it should be giving you enough return that your lock-in is justified. It's important to diversify your portfolio, whether it's real estate, a little bit of gold. It depends on your pool of capital. Some people like to venture into the startup space. So these are all things based on your risk appetite that one needs to keep in mind. The other key concept is vintage risk and liquidity and dry powder. So the concept of dry powder is, for example, when we had COVID, right? Some people would have invested a lot prior to COVID hitting the world before March 2020, and suddenly realized that during COVID, all the investments went kaput. The market had fallen, people didn't know what was happening. So at a time like this, it's really important to have some liquidity, which means dry powder. That means there needs to be some cash available that you can actually manage your investments in a staggered fashion. So, you wait for the markets, and for this, you need to keep an eye on what's happening globally, because all of this is all interlinked to each other. But it's important. It can be boring, I have to say myself as well, whether to read the mint, etc., and all the key concepts that can be always a little bit confusing. But I think as you learn the basics of investing, everything becomes a lot clearer and easier to understand. Hence, it's easier to keep a track of all this. The third, which is return optimization, to always know which products allow you the best tax returns for yourself, returns post-tax for yourselves. Really important to know this, because everyone has different requirements. Can you be locked in for 3 years? Can you be locked in for 1 year? Is long-term capital gain better for me? Is it better for me to invest in an FD where I'll pay a certain amount of taxation based on the slab? Are my returns justified? These are the key things to think about. The fourth being a behavioral bias. So, in the last post-COVID, we see that the markets have really done well. Lots of people have invested, they've made good returns, but it's important to know that the good times don't last forever. So one has to understand that what probably held true for 5 years may not be holding true for the coming quarters ahead or the coming months ahead. Therefore, it's important to sit on cash, to have an investment discipline, to use a staggered investment method, and keep an eye out and be alert. If there's questions, always, it's important to have reviews with people or fund managers people with the banks. And I think as an individual investor, it is your right to know what's going on with your portfolio and to ask the right questions to know that the discipline is being followed. Again, the return on one's portfolio personal finances truly is about the timeline that we've stayed invested in. We see, if we look at this graph, that the longer that you stay invested in the markets, the higher the returns, the higher the chances of multiplication of or compounding, as they say, of your wealth. Though in the short term, there's always peaks and troughs. They can be, and for example, if I had a conservative method to investment, I could see that my returns are quite not flattish, but a little bit, that's not as volatile as, say, somebody who's adding, and then where you keep it for long term, there's a lot of volatility on the green graph, but eventually with time it all multiplies. So the time that we stay invested is also a key investment principle to know which way we're headed. The more time you give, the better. So while you have short-term volatility and one looks at we're always looking at our portfolios online, on apps, on different things, getting worried, oh my goodness, this happened now. It's always good to give it time. And with time, it changes. So this is one of our favorite, I would say, not our favorite, but different fund managers, etc., that they use. It's like a little cheat sheet for the SOP, the process behind investments. So when a basket of products or a relationship manager approaches you, it's really important that they understand your objectives, and therefore this entire concept of investment and having somebody who's a financial advisor, why is it such a relationship driven concept, other than the knowledge, which is important to back it, is because they really need to understand where you're coming from. Once they've been able to identify what your requirements are, whether you need your funds for education, for medical, for marriages, for holidays, for retirement, it's important to analyze what your current investments are, what your current income is, what stage of life you may be in, and to assess the risk and the expectations that one hopes to achieve. Thereafter, it's important to build a strategy and have the correct asset allocation. Again, this is what we spoke about in the previous slides, whether it's a mutual fund, whether it's an AIF, whether it's a debt product, whether it's equity, whether it's in the world of startups. Really important to know what your risk appetite is and where you can invest. I think and then when we speak about restructuring and recalibrating, this comes down to risk mitigation, to know what's happening, to have constant reviews, to make informed decisions based on the current market situations in order to manage risk. And then, of course, one should have visibility. As an individual, you should have visibility on your portfolio, be able to, if, like I said, in a mutual fund or wherever you choose to invest, if your capital is so dear to you, you should be able to pull it out when you want. So it has to be managed in the correct fashion. And the same cycle has to repeat itself. And it's really important that, like we said, India is not an isolated economy. We're very much deeply impacted by what happens globally. And yeah, succession planning is the other important part, which is, I think, key to preserving one's wealth, and then make sure that the distribution happens in a timely and correct fashion to everybody. So yeah, that's it for me. Simple.
It's anything but simple, Connie, in the world of finance. All right. Thank you so much, Amit and Connie, for really walking us through some of the complex elements or parts of the financial world in itself. I want to take a moment to use an analogy to simplify it for everyone. In terms of inflation, I have this beautiful analogy. I keep using it with a lot of students is our money is like ice cubes, right? And if we don't keep it in the freezer, it melts away. That's how our money is, right? The heat that's in the environment is essentially the inflation. That sort of converts your ice cube into water if you're not freezing it enough. And our typical bank deposits that we look at are basically not our freezers, but the fridge. जहाँ पे पानी ठंडा रहेगा, but it doesn't stay as ice cube, which essentially means that I need to get the best freezer to keep my money in so that it grows as well, right? So that's what we're trying to keep our money or ice cube away from the heat or inflation. So just it's very easy to sort of connect to that analogy. If you just think of ice cubes, keeping it in an open environment, it melts away. That's the challenge that we face. And today, in a world where uh, we are looking at a certain growth trajectory for the country, a lot of us are also worried about our own individual retirement, age catching up with us. And will I be able to, in the era of AI, how long will I be more indispensable to the companies and the corporates where I'll keep earning? So where is my nest that I'm creating for my own future? That's what is something that gets often spoken about today. It's also important to now, with that context in mind about retirement, key, I'm not just looking at fighting inflation, but I'm also looking at growing my money to a level where I have a decent, dignified living in my retire years. So to do that is what we need to start thinking of a lot of these aspects. Whether I'm from the finance world or not, it doesn't matter. Money is going to treat each of us equally, right? Which means that even if I'm a scientist, I still need to, I may not, uh, you know, uh, uh, be very keen in the financial markets, but I still need to have the financial understanding of what my money is doing today, right? It's not very complex when you start breaking it down into smaller important elements to think about. So some of the things that Connie walked us through was to really look at the different asset classes that we can deploy our money into. If you can just move to the spread of assets that we showed, yeah, here's a set of asset classes that which is actively available to us. And today, the best part about the Indian ecosystem is that everything is available at a few clicks, right? I can, thanks to UPI, thanks to DigiLocker, thanks to the simplified processes of KYC, I can open a trading account in 20 minutes. Right, I can get into the market in under a day. I can deploy money. I can move my money from one account to other account in a jiffy. So, which also means that while the ease of operations is available, the complexity of available assets seem to be overwhelming. But when we go into each of these, I'll pick Amit and Connie's brain about each of these products, and we'll try and simplify that for each of us as an individual use case. Right, Amit, let's
Okay.
start with equity, which is probably the most spoken about, most covered in all the YouTube reels as well as Insta reels, and the newspaper talks about it every day. Uh, Tell us a bit more about equity market. If I were an investor in my 30s and 40s, I have a small set of quantum of money available. How construct my portfolio around investing in equity market? Where do I start?
So it's a great question, actually. I think the entire idea behind this deck is when you have slide 7, how do you address it, right? So let's just look at the market, right? If I look at the Indian equity market, and by that I mean the Nifty 50, right? Let's take any index. If I modeled it from the year 2000 to now, we have an IRR of close to 14%. 14% means 14% is the annual rate of return that I earn. Now, it doesn't go in a straight line. There's a lot of volatility around it. So one way to think about it is, if I am an investor with no knowledge, all that I need to do is put my money in the stock market, in the like the Nifty, right? The Nifty 50 or the BSE Sensex, they make indexes for us, which is, if you don't have the knowledge, here's a guy who's created the best 50 stocks of the Nifty or the best stocks of the BSE Sensex. And what they're telling us is, aap isme dal do. Don't worry about it, right? Now, if I look at it over the last 25 years, the Indian index has given 14% per annum. Now, think about it a little bit differently, right? First, whenever I look at a product, I need a benchmark. Let's say my benchmark is I want to make 10% return, hypothetically. 6% inflation, 4% depreciation, 10% is the basic minimum I want to make. So when a banker comes to me and says, "Aap equity mein invest karo," the first thing I'm going to ask him is, the first thing I have to look at is, okay, should I invest in a mutual fund or should I invest in a single stock. Now, a mutual fund is a specialist who's made a diversification of stocks and said, here's a bucket of 30 or 50 stocks. Please buy in this, and I will do all the homework for you. The other approach is to say, listen, I will just buy HDFC, Reliance, ICICI, whatever. You make your bucket of 5 stocks after you do your research, and you say, I'm going to buy this. What we need to understand is, and I've met so many people who've said, I will never invest in equity because I've lost all my money. The problem is you did not diversify properly. You never put all your eggs in one basket, right? So you look and you say that, listen, if I'm a new investor with limited knowledge, let me look at a diversified portfolio. So I will do equity mutual funds. Now, the next question, Santosh, to your point is, but listen, I can do equity mutual funds, or I can do an equity PMS where one guy comes to me and says, mutual fund में कोई return नहीं बनता, आप मेरे को पैसे दे दो, I will only do these 10 stocks, I'm a specialist in it. So I can do an equity mutual fund which has got 40 stocks, more diversification, or I can do a PMS which has got 10 stocks, less diversification, concentrated risk. The third thing that comes is I can do an AIF where the guy says, I will do the same 10, 15 stocks, but guess what? You can't take your money for 5 years, lock in it. So if you think about it, I am doing equity. I have 3 types of equity: a diversified equity, a less diversified equity, and a concentrated equity. And I also have a situation where I have full liquidity, less liquidity, very limited liquidity. So the question to ask the banker is कि देखो return क्या दे रहे हो मेरे को? If he's giving me 14% return, I might as well just invest in the index. If he says, here's a mutual fund which is giving 18%, here's a PMS which is giving 18%, I don't want the PMS. I might as well take a mutual fund because it's more diversified, less risk. So if the market gives me 14, I want a mutual fund which gives me 18. I want a PMS which gives me 21. I want an AIF which gives me 25. Because as I keep on going on the chain, my point is, to your point, Santosh, let us make every investor should make their benchmark. And then when you get this huge range of products, look at it in terms of diversification and liquidity. As the diversification and liquidity reduces, make sure your benchmark is higher.
All right. Thank you, Amit. To again contextualize for our audience, and a single equity is like going to a restaurant and ordering a certain food that you want to have. And then to create a portfolio is basically a la carte, right? I'll order a sushi with a Chinese, and then I'll also order a drink with that. So that's my a la carte. But when I go and have a thali, there's a preset food to taste a certain palette is available for me, right? In that I may like 2 things and don't like 3 things, but I get to have a buffet or a thali, and that's exactly what a mutual fund will essentially provide you to diversify your taste buds, right, into your equity risk. So to sort of again, if you take a step back and look at how does my money grow, or how should it essentially grow, we're looking at maybe 3 different paradigms for evaluation. One, what is the risk that I am taking by keeping my money with me or investing in a certain space? Is that risk very high, moderate, or low? How do I judge that? One of the best ways to judge that is against your safe investments under a bank FD or a government security. Right? If I were to invest or keep my money in a term deposit in a bank, I probably get between 5 to 7% in today's world, depending on the time of investment that I'm doing. Right now, I'm not talking about timing of investment. I'm talking about the length of the time that my money stays with this investment. Now, the beauty of it is there is enough historical precedence shown that equity market, although it is volatile in the short term, but that volatility gives you a better growth over a longer tenure. And when we talk about the tenure, keep in mind 3 years is still a short-term tenure. 10-15 years is what we should look as a time horizon to deploy our money in equities. It is not 1 year, 2 year, 3 years, right? Because that can be a volatile period. But over a period of 15 years, you will see that your return on investment keeps compounding, and that compounding is a very important element to really grow our individual investments. You don't need to be an expert, you don't need to be an MBA, we don't need to do our CFA, but these are very commonsensical thoughts when you think of it. And I'll probably connect it to our own country, right? Do we have enough confidence that India will grow in the next 15 years? As simple as that. Will India grow in the next 15 years or not? And if we have that confidence that yes, there is a growth trajectory that we're seeing, given what has been happening over the last few years and how India is positioned to leapfrog from here, then that is the place where you want to say that uh, at the fundamental level, the country is strong. At the fundamental level, we are poised for growth. If that is the case, I probably want to be a part of that growth journey, and equities are generally the best of the lots to give me higher returns. In terms of choosing the equity, I think that's for the experts. We don't want to today talk about which equity to invest in, but instead what we want to give you is some of the markers to look at. And Nifty is one thing that Amit mentioned. It's not some individual sitting and identifying 50 stocks. It is basically taken on the NSE's listed companies, and it looks at the largest of the large companies that are listed in the market. And that gives you a confidence that these companies are big enough that they're not shut down tomorrow. Right? They have a certain cash flow, they have a certain large business available to back them up for the next 10-15 years. And Nifty gives you that diversity so that you're not concentrating your risk on one certain instrument or one certain stock, but you also do a portfolio construction of it, right? So uh, within a class of asset, equity is a class of asset, we will need to diversify. The same rule will apply for us to also ensure that all my money is not kept in a single class of asset. I don't want to put 100% of my savings today into equity only, right? Because equity also is highly volatile, but I also need to have some safeguards. And what those safeguards and how does that safeguards come into play? Maybe Amit or Connie, if you can just briefly touch
Yeah.
upon debt
So
market as well, or what are the
yeah,
different debt instruments available
absolutely.
for
So,
individuals?
when we look at safeguards and debt, I'm glad you raised that point. I actually look at it from the concept of cash flow. So think about it as when I'm 25 years old, and if I have no requirement, any short-term requirement, I can put everything in equity. If I'm 30 and I have children and I need to pay for their education, then I start diversifying into debt, because debt gives me principal protection and starts giving me cash flow. When I am retiring, I want to put most of my money in debt, because at the age of 70 years old, I don't want to see a reduction in my capital. Now, what is the kind of debt we can do? So when we look at the debt market, fundamentally what a debt market is doing and what the bank is doing is exactly the same. A bank takes money from deposit holders and gives it to corporate India. The debt market also does exactly the same thing. The difference is, when I give money to a bank, I take the risk of the bank. When I put money in the debt market, I take the risk of the underlying company which has borrowed. So the debt market, based on which companies it is giving money to, has rating. So if I am lending to Bharat Sarkar, or I'm lending to State Bank of India, I'm lending to quasi-government or government, my debt gets rated very high, but therefore my returns are low. If I start, like supposing somebody gives money to Valtrust Capital, right? Now, nobody knows who Valtrust Capital is. It's a small boutique. So they will say, if I'm giving money to State Bank of India at 8%, I'm not going to give money to Valtrust Capital at 8%. I will give it at 15%. So there will be a debt fund with a lower rating, which will be giving money to more risky companies. So when you look at the debt market, you look at the rating. What I often tell investors is, the mistake we make is, FD is giving very low returns, so I put it in debt. But then the money that I would have kept in a FD, let me put it in AA or AAA debt. The mistake we make is, we suddenly start saying, array, instead of 9%, 8%, I can get 10 or 12 by doing different kinds of debt. But then what is happening is, the risk I'm taking in debt is going up. And then I really can't compare that debt to my FD because it's a different product. But you can get debt in the market to invest in real estate companies. You can get debt to invest in different types of corporate India. There are lots of debt. I hope I've answered your question, Santosh.
Yeah, thank you. I mean, I have a follow-on question. One of our audience members has asked us, what percentage of liquid assets has to be invested in risk markets as a senior citizen?
Okay.
Is there a thumb rule that we can use to understand if I'm about to retire and what part of my corpus has to go into a certain high risk versus low risk?
So we normally, it's normally when you start your investing journey and you're young, you are pretty much, let's say 90% equity, 10% debt. As you become older, you would want this ratio slowly to flip. So I think when you're looking at retirement, you probably want to have 70% debt and 30% equity, because then you still want some of your money to grow. The other way to think about it, when I speak to a lot of people who are in the retiring stage, is I say, how much cash flow do you need per month for your expenses? So supposing somebody tells me I need 1 lakh rupee a month for my cash flow expenses, my total savings is, let's say, 5 crores. So I will say, okay, let's take 2 crores of your money, put it in debt, because 2 crores in debt at 7% gives me 14 lakh rupees per year, right? So I know that my cash flow is looked after for the next 2 years. I'm sorted. I can take the incremental money and I can put it in equity. Or if I'm even more risk averse, so I feel, no, I have to pay for my grandchild's wedding or some education, based on what is your cash flow requirement, usko aap debt mein dalo. Where you feel that I don't need this money for the next 10 years, even if you've retired at 65, there will be a corpus of money you don't need beyond it. You'll only need at 80. So try to look at your cash flow requirements. Whatever cash flow you need, please put that and a little bit more of that in debt. Baki aap equity mein dalo. That is a more sophisticated way of doing it than trying to create a formula. Should it be 20% debt? See, Santosh, I've had people who say, listen, I'm 80, but I don't need the money. It is for my children. If it is for your child, ultimately, who is 30 or 40 years old, then put it in equity, because the risk of that money is based on the risk profile of your child who you're giving it to, not based on you.
Got it. So if I were to again simplify, I'm looking at on the time horizon again, on a time scale, if I'm looking at this money to come back to me for usage 10, 15, 20 years from now, then I'm better off giving it an environment of high growth, which is under equities. Right? If I'm a student starting today to invest, there's a question. So please recommend the investment for students of where to start. So this is exactly what we're speaking about. If you have a longer time horizon as a student, you're just starting up now, the best place for you to deploy your money as you may start earning through your internships or as you start earning through your career salaries is to keep in more and more money towards equity. While we're not saying 100%, because we also understand the implication of diversification, right? We also need to give it a overall asset class diversification, so the risk overall is minimized. But to the extent of the growth, I will push a larger percentage of my kitty into the equity so that it has that. Think of it like germination of a seed, right? I'm sowing something in the in my garden today. It needs those few years for that to become a plant and then a tree. I need to give that time and energy for it to really grow, and I'm giving that environment for it to grow. As a student, I think the best place for you to start putting your money could be in terms of equity, and then as a continuation of that, Connie, do you want to sort of help our audience understand more about the discipline of investing through SIPs, right? While we think of investing, all of us think that there's, again, Amit also mentioned there's 5 crore is available. I mean, those are utopian states where I have money sitting with me and I'm looking to invest. But for many of us, we're looking at to build that corpus or reach that corpus of 5 crore, right? how does one reach that, and how do you build in that discipline through SIPs and other opportunities?
So I think one great learning for me has been, Santosh, that, and looking back in hindsight, right? Even if 20 years ago one had invested like 1,000 rupees a month, or even 500, 20 years ago, 1,000 rupees still has a lot of value even today. But 20 years ago, it had even more value. Is that my advice would be that everyone start today. Like after this call, if you've not done it, you better start today, right? Is that you start with small amounts of sums every month. And I think how to break down how much free cash flow I have available for myself is that, for example, if I was in university and maybe if I have a pocket money from parents or I'm doing a job on the side, right? What are my cash flow requirements for myself personally, right? Whether I go out, whether I have fuel that I need to worry about, taxis, girlfriend, boyfriend, FNB, mobile phone, whatever it may be. But every month I am able to create a little ledger for myself, right? Where I write down I keep tab on what my expenses are, right? And I must have a figure in mind of what I can afford to put aside every month. And I do that very, very conscientiously, right? Um, and I think that discipline to have is key, because I think a lot of us in the Gen Zs, etc., we've all been more fortunate with funds available to us, right? We it's money has maybe less value, but for some it has a lot. Therefore, it's important. I think that if you respect the funds that you have, you put it aside, staggered investment style, you can see that the returns over the years will be tremendous. I can't give you a figure right now for 1,000 rupees, but for example, if you go into this, some online portals that you have like Masterstroke, etc., where if you even put in 1,000 rupees invested for a period of 20 years, growing at a rate of say 12%, etc., you put in the inflation amount of 6%, it can give you a beautiful calculation, and I would say 90% of the time the calculation would be correct. So if you give it time and you have a focus on being disciplined, that every month without fail, I will set aside some money, right? Which, unless of course, we always have unforeseeable circumstances. A lot of times we do save that money because it might come into good use later, but we're not investing it in the markets to make it grow. And I think that's the whole purpose of this presentation today, is to say that while we're so good at saving, let's make that money work for us. So I think a uh, staggered style of investing with small amounts of money starting at a young age is highly advisable.
Perfect. So let's move to a rapid fire. I have two, three questions, which is like I need answers which are like really less than a liner, right? So first one is to
Okay.
Amit. Okay, this is a question from one of our audience. He's asking how to manage timing in the equities markets. Is there something that you can do in terms of timing the market?
Yes, you can. You should look at the state of the economy. If the economy is doing really badly and you feel you can't put capital at risk, then be careful, wait for things to settle, and then invest. If the economy is doing really well, always keep some dry powder to put money when things go wrong and valuations come down.
Got it. Let's move to the next rapid fire question. This is either of you can take it. There are war clouds looming worldwide. Which is the safest investment today?
Today it's gold. Everywhere it seems to be gold.
Yeah,
Gold
I
is the
think
color of the clouds is gold currently.
whenever you see too much economic uncertainty, gold is a nice asset class to invest. Though I will say, always please view gold not as an investment, but as a security.
Got it. The next one is a pointed question. Are there any rating agencies or quality ratings for PMS or AF in India?
Uh, the rating agencies are there. Very few rate. See, on the equity AIFs and PMSs, there is no rating. On the debt, some people do it, but it's very rare. So as of now, it's pretty much no.
All right. So that brings us to the close of the discussion. We have plenty of questions. So what I'll do is we'll have Rhythm collate those questions as well. Feel free to share your questions in the chat window. Rhythm will collate that and we'll try our best to get pointed answers to those. A disclaimer: we are not going to represent any organization here. We are not going to recommend any certain specific investment advices. We are not going to be advising you on which stocks to pick. Please don't post those questions. Any other broader questions in terms of the whole ethos of personal finance, we are happy to take those questions as well. To sort of sum it up, so I think the three key takeaways for me from Amit and Connie's conversations were diversify both at the instrument level and also at the asset classes level. Diversify so that you're not keeping all your eggs in one basket, but spreading your risk. That said, your most important element to think of while investing is this investment going to yield me better returns than inflation? Because go back to my analogy of ice cubes. If you don't put it in a freezer, it is going to melt down. That's what will happen to our money as well. So keep that in mind before you start looking at the return on investment. And like Connie said, there are plenty of tools available today for free access, even within the Indian market as well as global arena, to look at really sort of drag and drop and see how my money can grow at 12, 13, 14% rate, as well as what are the risks that will come into play in these elements of investment that we do. And the most important takeaway is we are not a cocooned environment. We are a globally exposed economy, which means that if there is high pressures in the oceans, we are going to get rains, right? So we need to be clear about it that if the US market is changing the rate, at least I need to keep an eye out to understand what implication it might have. There's enough material that comes out in the news, opinions, and articles. It is to our benefit that we start reading them. We may not understand on day one, but that's not the expectation. It's about keeping track of what's happening globally and how it is going to impact us as an individual investor to ensure that my personal finance is robust and also solid when I'm looking to grow it and retire at the end of my working career. So please keep an eye out, keep reading, be curious, and we're happy to take more questions and answer through an email. And Rhythm, could you please share the cheat sheet or the summary of the whole session? We have created a cheat sheet for you to take away as a flyer so that the learnings can be more internalized for you all. With that, I thank Amit and Connie for really walking us through some of the important global aspects and also pinpointing into various instruments of investment and how does one individual at different age groups look at investing or growing their own capital. Thank you, Amit. Thank you, Connie,
Thank
and I
you.
thank my
Thank you,
audience.
Santosh.
Thank you. Thank you, Santosh.
Thank you,
Thank you.